Hello, this is Matthew with Copley Financial Group, and today we're going to do a quick market update. The Federal Reserve raised interest rates yesterday as expected, anticipated a 75 basis point increase, and that's exactly what they gave us. However, what did not happen, which the market expected, was some kind of a soft pivot. And what that means is the government was going to tell us that they were going to stop raising interest rates as much. Clearly, the economy is having problems. The data is showing us that these higher interest rates are having a major impact on the housing market and a lot of areas of the economy. And so the Fed did not give us that. So what it looks like is the Federal Reserve is going to do a hard pivot. So they are talking tough, like they're going to keep raising rates and get inflation under control. However, I have a feeling, as I mentioned in a previous video, that we are going to have a similar situation here that England had, where they had to come in and do what's called a hard pivot. And this is where they change course. They start lowering interest rates or at least stopping raising interest rates because something happens in the market. They break something. So this is what we expect to have happen. And at that point, it's going to be very, very difficult to determine when to get more aggressive. Because if you wait until that pivot happens, it's going to be too late. So we have to buy now. What we're doing now is we're getting a lot more aggressive on the investments. You're going to see on your accounts a lot more stock buying, a lot less cash on the sidelines, a lot of the conservative hedges and things that we put in place. We are now going to be buying stock. Now we are going to be buying good quality stuff, value stocks. We still believe that that's the place to be. Companies with good cash flow, good dividend yield. So you're going to see a lot of that. We are not interested in these companies that don't have good profits and earnings. I think there's still a lot farther down, a long way to go down for some of those companies like the Teslas and companies like that. So look out for that. We're going to be more aggressive. I will mention that the new buffered index that we just got from Goldman Sachs is absolutely incredible. It's one of the best ones I've ever seen. And so for those of you that have buffered indexes that are coming due, we're definitely going to be renewing them in the new one that's coming out. And we are also going to be looking at opportunities for just people adding additional money in. And just a quick note, the buffered index, the way this new one works is it's just 18 months, which is better than the 24-month ones we've been getting. So this one's 18 months. If the stock market goes up anywhere up to 25%, you get the whole thing. So that's an internal rate of return of 17%, which is very strong. And so if the market goes up 20%, you get 20. If it goes up 25, you get 25. But you are agreeing to give up everything above a 25% gain after 18 months. So it's going to go from November of 2022 to May of 2024, 18 months. And for giving up everything above 25%, we're getting some incredible insurance. So the first insurance policy is if the market drops from here, the first 20% down, you actually get the inverse return. So not only do you not lose money, you actually make money if the stock market goes down anywhere from 0 to 20%, which is amazing. If the market's down 10, you actually don't lose any money, you actually make 10%. If the market's down 15, you don't lose any money, you actually make 15%. So great insurance policy. And if the stock market drops more than 20%, you get reimbursed on your first 20% of loss. So if the market was down 25%, you'd be down 20%. You'd be down 5% because you get reimbursed on 20% of your loss. So with that, I think it's a great investment right now. The insurance is super cheap. At the end of the day, it tells you that Goldman Sachs and the rest of the stock market believes the market's going to be a lot higher 18 months from now. And I agree. I think the market will be a lot higher. I don't think this is going to be an economic recovery. I think it's going to be an inflationary recovery. I think we're going to see a lot more inflation. I think it's going to be a lot worse than they're telling us. The Wall Street Journal and all these different market analysts are saying that inflation is going to come back to the 4% range next year. I just don't see how that happens. I think that we're going to continue to have higher inflation. So we're going to be focused on those companies that are going to make money. And when that hard pivot happens and the Fed changes direction, we're going to see a huge gain in our investment. So we're going to get out in front of that. You have to have the courage and conviction of knowing what's going to happen ahead of time, and we have to buy now. So that doesn't mean the stock market's just going to start going up now that we're buying a lot more stock. But it does mean that we think the stock market will be up a year from now, year and a half from now. It could keep going down temporarily in the short term. You can't predict what's going to happen with the markets. Obviously, there's a lot of emotions that get involved with the markets, but I do think there's some great catalysts that we're looking at. Obviously, with this recent rise in interest rates, we saw a 500-point drop in the Dow the next day, and the markets are really down. The S&P 500 is still down 20% for the year. The Nasdaq's down over 30% on the year. So it's a good time to buy when the market's cheap and on sale. You need to buy it, and so that's what we're doing. We also have some other catalysts. The election's coming. It looks like from all of the data, it looks like the Republicans are going to win the House and possibly win the Senate as well. I think that's going to create a catalyst to have the markets go up. A lot of times the market trades on sentiment, so I think people are going to view that as a positive. I personally think you're getting rid of one set of bad politicians, and you're bringing in probably a new set of bad politicians, so I don't think a whole lot's going to change. And if the Republicans want to do something, well, Biden's just going to veto it. So I don't think a whole lot's going to change politically. But I do think that it could be a positive catalyst for the markets, just from perception. Also, December is typically a really good time of the year to invest in the stock market. We commonly refer to this time of the year as a Santa Claus rally, and so the markets typically do well. And so with all that in mind, we definitely are going to be moving a lot of the money from cash to the stock market, and we've already done some of it, and you'll see that on probably your next statement. So that said, I hope that's a good market update on what we're doing going forward. If you have any questions, feel free to reach out, and we'll be happy to chat with you about your own individual accounts.